Every time a headline about a new tariff or trade dispute hits the news, most investors panic. They see all this global volatility as a huge threat, so they pull their money out, sit on the sidelines, and completely miss the opportunity. But what if I told you that's the wrong way to think about it? What if, while everyone else is running for the exits, Wall Street is quietly using that same chaos to generate massive returns? In this video, I'm going to show you exactly how to turn this market chaos into your greatest asset for growth. So stick around. Now, you've probably been told that the market hates uncertainty. In the short term, that's true. Volatility spikes and fear takes over. But what savvy investors know is that chaos is really just another word for mispricing. While the mainstream media is busy selling fear, a smart group of investors sees this uncertainty as a huge opportunity. That's because these trade disruptions aren't just random noise. They create predictable patterns. When supply chains have to reroute, new winners emerge. When policies shift, entire sectors can gain an advantage. The chaos isn't the threat. It's the map showing you where the money is going next. So, how can you start profiting from this? Let's break down the 3 key strategies you need to know. Strategy 1. Invest in the toll roads of global trade. First, you want to find the companies that act like toll roads for the global economy. These are the businesses that make money from the volume and volatility of trade itself, no matter who's winning or losing a specific trade war. Think about logistics and shipping. When supply chains suddenly have to shift from one country to another, it creates a massive demand for new routes and transportation. Look for the companies that own the trucks, trains, and ships needed to move all those goods. Railroads, for instance, can get a boost from onshoring as companies try to secure their supply lines. Package delivery giants and firms specializing in trucking technology also do well because they help other businesses cut costs during these disruptions. Another great example: market makers and exchanges. These are the companies that provide the plumbing for the financial markets. When everyone else is panicking and trading volumes are through the roof, these firms are facilitating all those trades and benefiting from the increased activity. It's all about finding the businesses that get paid no matter which way the traffic is flowing. Strategy 2. Identify the new winners from trade diversification. Next up, you have to follow the money to the new winners. A tariff on one country is basically a subsidy for another. As companies scramble to diversify their supply chains away from geopolitical hotspots, they create enormous opportunities in new regions. We're already seeing this play out in a big way. As companies shift production, countries like Vietnam and Mexico are emerging as major beneficiaries. As of early 2025, exports to the US from Vietnam and Mexico have surged, especially in electronics and automotive parts. In fact, foreign direct investment has poured into Southeast Asia and Mexico to build out this new manufacturing capacity, with countries like India and Malaysia also seeing significant gains. Your job as an investor is to follow that capital. You can look for ETFs that give you broad exposure to these rising economies. Or you can dig a little deeper and find the specific companies that are capturing this new business. Think industrial park developers, local manufacturers, and the infrastructure companies building the ports and roads needed to support all this growth. The global trade map is being redrawn, and you want to own a piece of the places getting new, bold lines drawn right to them. Strategy 3. Focus on defensive cash flow and AMP, inelastic demand, and the third strategy is all about anchoring your portfolio with businesses that are insulated from the chaos. When things get uncertain, you want to own companies that sell things people need, not just things they want. These are your defensive sectors. I'm talking about healthcare, consumer staples, and utilities. No matter what the latest tariff news is, people still need medicine, they still buy toothpaste, and they still pay their electricity bills. These companies tend to have incredibly resilient demand and the power to pass on increased costs to consumers, which makes them a safe harbor when other parts of the market are rocky. But don't just buy any company in these sectors. Look for what the pros call quality companies. These are businesses with rock-solid balance sheets, low debt, and a long history of paying out dividends. They have the financial muscle to weather any storm and typically emerge even stronger. This isn't about chasing crazy growth. It's about owning the bedrock assets that provide stability and reliable cash flow right when you need it most. All right, let's put it all together. First, invest in the toll road businesses that profit from the volatility itself. Second, identify the new geographic and sector winners that are being created by trade diversification. And third, anchor your portfolio with defensive, high-quality companies that have demand you can count on. Stop looking at volatility as a threat. Start seeing it as a predictable pattern you can use to your advantage. Uncertainty isn't something to fear, it's something to prepare for. And if you're a savvy investor, it's something you can profit from. If you want more ideas on how to build a resilient portfolio that can handle any market, make sure you subscribe and then go watch my video on the top 5 defensive stocks for a recession. Thanks for watching.